When a stock rises, it often feels like relief. But some tickers get more unsettling the higher they go. Because the move might not be driven by problems being solved, but by problems being temporarily hidden. In aerospace and defense, and especially in aircraft engines, a small defect can turn into years of cost, delays, and trust erosion. Today's story is RTX Corporation, a US-based aerospace and defense company listed on the New York Stock Exchange. On the surface, it looks solid and the headline sounds strong, yet investors keep circling back to the same question. Is this rally proof of stronger fundamentals, or is it a pause while an unfinished issue stays out of view? During the trading session, RTX moved sharply. The intraday low was around $171, the high was around $177, and the price hovered near $176. Bouncing from the low and sticking near the highs signals strong short-term buying. Above that sits the 52-week high around $181. At levels like these, the market demands proof. Break higher and it becomes a trend. Fail and it becomes overhead supply. RTX is one company, but it behaves like three different businesses under one roof. Collins Aerospace is aircraft systems and aftermarket services, a business that benefits when planes keep flying. Pratt and Whitney is aircraft engines, a business that can generate long-lasting profits when things go right, but can bleed cash and credibility when things go wrong. Raytheon is defense, a business tied to government budgets and geopolitical demand. This mix can diversify earnings, but it also creates a trap. A positive catalyst in one segment does not actually resolve risk in another, even if the stock price acts like it does. The central mystery right now is the Pratt and Whitney GTF engine powder metal issue. This is not a simple quality headline, it is a fundamentals issue. Fundamentals are the long-run money-making engine of a business, meaning revenue stability, cost predictability, customer trust, and durable cash flow. A disruption here can hit all of them at once. Here is the plain language version. GTF is a geared turbofan design. In simple terms, the engine uses gearing to let different parts spin at different optimal speeds, boosting fuel efficiency. Airlines love efficiency because it can lower fuel burn, but higher complexity also raises the difficulty of manufacturing control and maintenance. Powder metal refers to manufacturing routes where metal is processed as powder and consolidated into parts. Inside an engine, you get extreme heat, pressure, and vibration over and over, so tiny material issues can grow into cracks or failures over time. This issue was formally surfaced in 2023. RTX disclosed that a rare condition was found in powder metal used for certain GTF engine parts, that inspections would be expanded, and that financial charges would be recognized. For investors, that single line is heavy. Expanded inspections mean more shop visits. More shop visits can mean maintenance capacity constraints, stressed parts supply, and rising costs. In a typical aircraft engine case, the process is fairly structured. The manufacturer quickly narrows the affected part numbers, production lots, and the population of engines involved. Then safety risk is assessed, regulators are engaged, and inspection or replacement guidance is issued. Over time, the key expectation is that the map becomes clearer. How many engines, how long, and what the end state looks like. What keeps this feeling like a mystery is that investors do not sense the uncertainty shrinking fast enough. An engine issue is not like swapping a single component and moving on. It can disrupt airline operations and the entire maintenance pipeline. For an airline, a grounded aircraft is immediate loss. You rebook passengers, adjust routes, and scramble for spare capacity. Those losses come back to the manufacturer as pressure. The manufacturer expands inspections to protect safety, but expanding inspections can overwhelm maintenance slots. When slots are tight, wait times grow. When wait times grow, more aircraft stay grounded longer. That feedback loop can turn into multi-quarter waves of cost. That is what investors fear most, not just a one-time charge, but a prolonged drain tied to logistics and throughput. And yet, the stock can rise during the session. That is where doubt intensifies. If uncertainty remains, why does the market buy with such confidence? One answer is that defense-side catalysts look powerful. In early December 2025, reports highlighted a roughly $1.6 billion sustainment contract related to the F-1135 engine used on the F-35 program. Defense sustainment is often viewed as recurring revenue. Platforms operate for years and engines require ongoing maintenance. Investors see a sturdier floor under cash flow. But this is the heart of the fundamentals mystery. A defense sustainment win does not automatically remove uncertainty in commercial engines. If the price rises anyway, the market may be treating it as an offset. Two plausible narratives emerge. First, the market believes the worst phase of the GTF issue is past, that schedules and costs are moving into a controllable range. Second, the market has not fully resolved the uncertainty, but defense strength is overwhelming fear for now. The first narrative supports a more durable uptrend. The second narrative is fragile because a new cost signal from the commercial engine side could quickly unwind the premium built on defense optimism. Investors call it a mystery because outside observers cannot be sure which narrative is driving the bid. Another storyline adds fuel. On December 4th, 2025, Raytheon announced an expanded collaboration with Amazon Web Services focused on cloud-based tools and technologies for space customers. Defense and space are becoming more data-driven. Satellite and sensor data keep growing, and missions depend on fast processing, sharing, and decision support. Cloud capabilities can help. So the market may read this as RTX expanding from manufacturing into data and software-enabled operations. But compared with typical defense contracting, this also feels unusual in its timing and clarity. Many defense awards emphasize concrete scope, deliveries, and dollar values. A collaboration announcement points to direction, but the timing and size of revenue conversion can take longer to verify. Expectations can reprice quickly, while confirmation arrives slowly. That gap creates another layer of uncertainty. The market may be valuing positioning more than near-term earnings. If the positioning does not translate into contracted revenue and margin, a reset can follow. A key anchor point investors watch is the 2025 guidance uplift reported around October 21st, 2025, along with a backlog around $251 billion, roughly $148 billion commercial and $103 billion defense. Backlog signals demand that is already booked. But there was also mention of tariff-related cost impact around $0.5 billion. Demand can be strong while margins face pressure. That is why investors focus less on headline revenue growth and more on margin and cash flow predictability, especially when an issue like GTF can produce costs across multiple quarters. So, here's the bottom line. The current narrative is defense certainty pressing down commercial engine uncertainty. But the future path depends on whether the GTF powder metal issue becomes a clearly bounded, predictable schedule with controllable costs. If predictability improves, the uncertainty discount can unwind. If uncertainty resurges, the premium can be pulled back quickly. The real fear is not that there is a problem, but that the problem could grow again. In practical terms, the short-term line that matters is around $171. If that breaks, the intraday bullish structure is damaged and risk control becomes priority. On the upside, around $177 is the first gate. If price clears and holds, the next test is the 52-week high near $181. Medium-term, defense sustainment and a large backlog can support the downside, but tariffs and GTF-related costs can still pressure margins. Long-term, it can be wiser to scale rather than chase near highs, because engine issues can take time to normalize, and the best returns often come from buying quality during pullbacks when uncertainty is priced in. And before we wrap up, I want to hear from you. The ValueStir channel is always looking for your tips on stocks and coins you are watching, whether they are listed, unlisted, or preparing to list. Drop the ticker in the comments and tell me what feels off, what you cannot reconcile, and which detail you think everyone is missing. Your comment could be the next thread we pull that turns into a full investigation. Thank you to everyone who keeps coming back to watch, and to those who subscribe. Hit like, leave thoughtful comments, and share the video outside the platform. I truly appreciate the support, and I will pay it back with better and better content. This was ValueStir.